Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Genius Sports. This is a top 5 holding for me, has been for quite some time. I was a buyer in the $2 to $3 to $4 range. Now it's up to almost $7, down about 5.5% after their Q4 earnings were a bit lackluster. If you look at their year-to-date performance, solid. 1 year out, 31% up. A lot of ups and downs here. Again, if you zoom way out to the 5 year mark. This was a D-SPAC, so a lot of negatives that come with D-SPACs, dilution, ownership by private equity companies that kind of lead to secondary offerings. All of that stuff has impacted Genius Sports. I talked about what they do, some of those negatives in previous videos. I will link those down below, so check those out. I won't go into detail here. Let's look at the earnings themselves. Up about $1 million over what analysts expected for Q4 2023 and 2023 as a whole. Then if you look at their overall initial guidance that they gave at the beginning of last year, sort of conservative on their front. They hit 391 for their guidance, and then they hit 413 for the actual results for 2023. Growth of about 21% year over year, pretty solid. Their adjusted EBITDA more than tripled, also exceeding initial guidance of 41 million. But again, you got to remember, adjusted EBITDA is different than actual bottom line. Group net loss was actually 86 million for the year because of stock-based compensation, depreciation, amortization, all of that stuff. And they were also free cash flow negative for the year, although they did hit free cash flow positivity in the second half of 2023. And based on their guidance, they're expecting to generate positive free cash flow for the entirety of 2024. But 2024 is what kind of disappointed me. You have growth expectations of about 16%, only 300 basis points of margin expansion versus 800 basis points last year. And this is a business that needs to expand that margin quickly in order to sort of get to their valuation metrics that are expected by the market. And then you have a 41% growth on that EBITDA side. So really, I think I was expecting closer to 20% growth on a revenue basis, kind of continuing what they've seen in 2023, but they're slowing. The question is going to be, are they sort of sandbagging like they did last year? My hope is that they are. If you sort of bump that up by 20 million bucks, you get to that 20% growth rate that they're expecting. And I think some of the things they mentioned, some of the products they rolled out during their call are going to lead to better results, but I think they're just being conservative, not knowing what's going to happen with Florida, not knowing how the states are going to roll out in 2024. There are some expectations around states rolling out already. North Carolina is going legal soon, but other states are certainly a question mark. And then obviously the big boys like Texas and California are still not legal. If you look at how the actual business lines are going, let's look at the full year 2023, 31% growth on the betting side, 11% growth on the media and technology side, 4% shrinkage on the sports tech side. And that's kind of the business I've been interested in. The sports tech side was down 15.8% in Q4. They really talked about why that is, about how they're getting more non-cash considerations in the form of official sports rights and streaming rights instead of actually selling those services for money. That's a great thing, but then you really have to think about what does that mean. When you look at their sports rights expenses, they're a big part of their overall expenses. For 2024, the estimates are about $195 million in rights costs. But then if you go back to their 6K in the last quarter, they had an expectation of remaining rights of about 171 million for 2024. So it's already gone up by 24 million. I'm not sure what's driving that because they don't lay out specific deals. Was it the football sports data co-rights that they signed with the Premier League? Maybe, whether new rights that they signed in there. But if you kind of think about, well, we're getting these rights and streaming rights for free, and we're not getting sports tech revenue because of that, that doesn't really pass muster when your costs are increasing by 24 million in just one quarter on the data rights side. And we'll get a bit more detail on this and how that translates to 25, 26, and 27 when they release their updated 6K in about a week. So keep an eye on that one, but I'll be interested in seeing what that means for future data rights costs and how that will impact future margins, because I really haven't baked a lot of this in yet for 25, 26, or 27, if it's already going up from what was shown on the last 6K. As you kind of look at this, you can also say that, hey, maybe they're kind of pushing their streaming product. When you talk about BetVision, they talked about BetVision in a big way as that's their streaming product that they sell to bookmakers. How that product itself gives them 3 times growth in total handle from streamers to non-streamers, 3 times growth in total in-play handle from streamers than non-streamers. Again, a very small portion of their business at this point, but if they're pushing that into the future, They talked about rolling that out to other bookmakers, other sports as well, and really talk that up as a way to grow in the future. So if that helps their betting technology grow faster than sports tech, which is maybe a better margin business, that's important. Speaking of in-play is growing at a really good clip as well. And in-play is important for a company like this because they make a lot more money, 3x the money from non-in-play bets than they do on in-play bets. So from in-play bets than they do on non-in-play bets rather. So they make more money on the in-play bets, and that's growing at 60% and 140% on a quarterly and year-over-year basis. That's rather 60% on an in-play handle basis and 140% on an in-play GGR basis. That's really impressive. And now it makes up about 20% of the NFL GGR. And that's kind of low when you think about what in-play is in other more mature markets. In-play bets are about 50% plus in other more mature markets like Europe. If they can take this 20% bet line and move it to the 50% bet line in the future, take that 1.5% margin that they get from non-in-play bets to the 5% margin or so that they get on in-play bets, they're going to make a lot more money from betting as that transition happens, if that transition happens. So those are a lot of important things that they talked about here. Another thing they laid out is dollar-based net revenue retention. And again, a lot of this is going to be above 100% because of the growth of online sports betting, because of the rise of in-play betting and improving win margins and all of those things. So it was 126% in 2022, 118% in 2023. Kind of disappointing that it's dropping so quickly already, just 1 year in, especially on the US side where the top 25 US customers were 206% growth in 2022, only 129% growth in 2023. I was hoping that this would stay higher longer and maybe even improve a bit as the online sports betting market grows quickly in the US, and that's not really the case, so it's kind of disappointing. But that's another slightly negative thing that you see in this earnings, that this is dropping this quickly already. But we'll see how we look in 2024 as shareholders, because I would expect this number to be well above 100% for years to come as the online sports betting market grows, as in-play betting grows, as win margins grow, as they roll out new products to current customers and kind of renew them at better deals. But maybe part of the problem is, are they actually renewing these deals at better numbers, or are they similar numbers or even worse numbers when they talk about these data rights deals and the deals that they're making with the bookmakers? So that's the question mark with this company. There's a lot of obfuscation when it comes to the data that they deal with. They don't release the contract deals. They sort of said, we just signed a contract. And it's like, well, that's great, but is it a better contract or worse contract? They don't really speak to any of that on the calls or the announcements of these contracts. And that is difficult for investors to get their hands around. But when you see something like this, when some of this growth is starting to slow, yes, it's still above 100%, but it should be, because the market itself is growing at a pretty good clip, especially in the United States. New states are coming online, and they're going to continue coming online. And the nice thing for a company like Genius is that when a state like North Carolina comes online, there's no real incremental cost to them. They just already have a deal with DraftKings or whoever they have a deal with. And as DraftKings goes online in North Carolina and starts making money there, Genius starts making money there. They don't have to spend any money to make more money. And that's the beauty of this business. Once you get those rights going, as more states come online, as more countries come online, as more deals come online, you're just making more money from those states. It's just a bottom line improvement as well as a top line improvement. So it's a margin improvement and a top line improvement. And that is a pretty good thing. So again, looking at 2024 guidance, I think they're being a bit conservative. You can kind of see 480, 175. The growth is okay at 16%, but I was expecting a bit more, and I think guidance analysts were expecting a bit more as well. Again, free cash flow positivity in the full year of 2024. They said that it's going to be negative in Q1 and Q2, and then positive in Q3 and Q4 again. So that leads me to believe that the margins on the free cash flow basis are not going to be huge, but we'll look at that in a second. A couple of things to mention here. A couple of risks that are always out there. First, ownership is a problem. Their biggest shareholder is still Apex Partners. Just in September, they did a secondary offering of about 20 to 30 million shares. I think it was 20 million plus an additional 3 million or something like that, actually, at $5.35, because they're continually selling their shares. And whenever you have such a big private equity shareholder, they could always issue secondary offerings that don't give any money to the company, but sell at a lower price than is currently being offered. And that's what happened last time. The stock was trading close to $6. They offered at 5.35. The stock immediately falls to that price because that's what the secondary market is judging the fair value at. Will they do that in the future again? Probably. That's just what's going to happen. So that worries me for a second. If you kind of look at their other shareholders, there's an individual investor who owns 10% of the shares, a couple of investment advisors that own another 15% of the shares. So there's companies out there that could potentially have secondary offerings. This guy could sell a bunch of his shares. That will be a problem because a bunch of float will suddenly be on the market, and that will lower the price. On top of that, if you look at their overall share count, it's 209 million versus 207 when I last did my analysis. So there's some dilution there. They've been diluting quite a bit via stock-based compensation, $89 million in stock-based compensation in 22, down to $35 million in 23. But they're still going to continue to dilute via stock-based compensation for the next couple of years. That's just how they've been doing business. But when you look at free cash flow being positive, it's not all celebration because there's dilution happening. And that's why when we look at my analysis, I have a negative buyback here, meaning that the number of shares will be increasing. As I look at my analysis, I'm looking at 21% growth for actuals in 23, but then I'm dropping it down from 20% to 16% to 16% to 15% to 15% in the next couple of years. I do see increasing margins, 4% next year. It's kind of in line with what analysts are projecting. And if you look at Q3 and Q4 results, kind of in that 5% range. So I think in the near term, they're going to hit 5% pretty quickly. And then I'm expecting expansion into 12.5% by 2027. If you listen to management, they're talking about 30% EBITDA margin goals in the future. This kind of business generally has 50 to 60 to 70% cash conversion. So I'm kind of being on the conservative side when it comes to mature margins. I'm kind of thinking 30% is kind of optimistic on their end. If you look at Sports Radar, a more mature company, they're kind of in the low to mid 20% range. I think that's kind of where Genius is going to fall by 2027, and I'm taking about 50% of that as free cash flow conversions to get to a 12.5%. Again, negative buyback, issuing about $234 million in shares via stock-based compensation. Don't expect them to buy back shares, but they do have the money to do something with their balance sheet. No actual debt, positive on the free cash flow side. They have about 100 million plus in cash on the book, so they can buy back shares with that, certainly to offset stock-based compensation or make some acquisitions to help juice up growth and or margins. So as I look at that, you can say that conservatism is built into the free cash flow margin side. If you believe management's 30% EBITDA margin goals, maybe this is 15 to 17% free cash flow margins. As I look at where this stock should be valued when it's a bit more mature, kind of in that 4% free cash flow yield as growth starts to slow. Maybe in this market, you're saying that's a bit conservative. Maybe it should be in the 3% range. You can kind of play around with these numbers. I will share this spreadsheet down below. Just hit file, make a copy to play around with it. You can change these scenarios to whatever you want them to be. For me, because of the risk inherent in the dilution, in the fact that there's secondary offerings, I'm probably being a bit more conservative. And conservative. On top of the secondary offerings, again, they have 209 million shares, but there's a bunch of vested warrants from the NFL that the NFL can exercise at any time at like 0.0001 cents, and they could sell it right away if they want to, increasing float, increasing dilution. There's a bunch of unvested RSUs and PSUs that could become vested eventually. And if you take all of those shares into consideration, that's 244.4 million shares versus the 209.1 currently being traded. That's 15% dilution right there. So I'm being conservative here to not have to be conservative on the target return side of things. With all that in mind, I get a fair value of about $5.87, so about 12% below where it is right now. Again, if you think about this dilution here, if you were to dilute fully, you'd get to about $5 or about 24% below where you are now. So keep that in mind. We're talking about some negative buybacks here. If you think that's a bit too conservative, you can make the adjustment here as well. But that's kind of my fair value assessment at the moment. When I looked at this last time, my fair value assessment was closer to 650, 660, something like that. So it's dropped a bit. And it's dropped a bit because growth expectations have dropped a bit. Margin expansion expectations have dropped a little bit based on the earnings announcement, based on the guidance they gave. And I'm always a bit conservative with a company like this with a D-SPAC because there's the threat of secondary offerings, the threat of dilutions from a lot of this vested nonsense that they have, a lot of these unvested RSUs and PSUs. There's some risk here for sure. I do think this is a really good business. I like what they do. If you are investing in the betting space, this is a pretty solid investment to make. That's why I'm invested in it. But if I were to buy some more here, I'd have to have a lower price than it's trading at today. And I usually target a 10 to 15% return. At a 10% target return, my fair value here is about 587. I get an expected return from today's price of about 7%. And again, you can look at it differently. If you feel like the scenario here is a bit conservative and it should be in the 3% range, you get a 15% return from today's price point. So that's why I'm not selling. I think there's certainly some upside here. I think if you look at this from a margin maturity perspective of a 15% margin, that gets me to about a $7.10 fair value, but I'm not quite there yet from what they've shown up to now. And then as I look at this from a 10 to 15% target return perspective, I get a fair value anywhere from $4.70, which is 30% below where it is today, to the 587, which I mentioned before, which is 12% below where it is today. So if I were to buy more here, I'd probably need a price point that's kind of in that $5 range, honestly. That's kind of where I was at about 6 months ago when I last did a video on this, or maybe it was 3 months ago. That's kind of where I'm at right now. I think the investment thesis has gotten just a bit worse based on the Q4 earnings, but it's still pretty good. I still like what the company is doing. I still like the potential here. I like the fact that they're free cash flow positive. They have the ability to actually use their money towards some acquisitions that will be helpful to them. They did talk about AI during the call, but again, I'm not really clear what they're doing with the AI stuff out there just yet. Certainly doing some AI analysis with some of their edge products, which help you develop odds on the fly, things of that nature. Some of their data analytics stuff probably uses AI, but again, is that really AI? Or is that just data analytics? They're signing new deals for their data analytics product, their sports analytics products with the WNBA, other companies. There's always new deals that they're signing, so I'm excited about that. So still a company that I like what they're doing. I like the fit within the betting ecosystem. I think they're one of the two biggest players in that ecosystem with SportsRadar, but it's not a duopoly like some people say. There's other companies out there like IMG Arena and other companies of that ilk. So there's more competition to be had, and those sports rights deals are not going to be any cheaper, and that's the main risk here. And I'm already seeing some of that with the 195 million sports rights cost that they're projecting versus the 171 million that they had in the last 6K. So not sure where that comes from. We'll have to check out the next 6K to see how that flows through into 25, 26, and 27, because they do show that stuff in their 6Ks, just not the one that they released with the earnings. It'll be about a week out that the updated 6K is out. So those are my thoughts on Genius. Let me know what you think. If you disagree, agree. Again, the main risk here in the short term is going to be another secondary offering from Apex Partners, continued dilution, the fact that the NFL could take advantage of those vested warrants. And if they do, that is going to be some severe dilution. I think the NFL warrants themselves are 18.5 million shares. So you're talking about plus 18.5 million. That's an additional 9% dilution. So right off the bat, that's 9% share price drop. And if the secondary offering from Apex Partners comes out, and if that's, 5 to 10% below share price, is that going to lead to opportunities to buy? I think so. Would I increase my position here? I would, but I would have to get a really good price, and that price would probably be closer to the 470 than the 580, honestly, for me, simply because I already own a buttload of these shares. And that's just me personally, but let me know what you think about this company. Let me know if you disagree with anything here. If you like the video, hit the like button below. If you are new here, subscribe. If you disagree with anything, comment down below and let me know where I'm wrong, where I'm right, all of that stuff. Always like hearing from you guys. Thanks for watching. Bye.